everybody. Luke Gromen, FFTT. Hope you are well and had a great weekend. We definitely had a great weekend here. We was down in lovely Marietta, Ohio, watching the Marietta Pioneers win two big conference games on Saturday, including the second game of the doubleheader. We had a walk-off home run to win in the bottom of the 10th. Brett Carson, number 4, Marietta, stud hitter, had a nice oppo left field home run to win it, which was super exciting for the guys. Loved watching them celebrate. So with that, we're going to jump right into the questions. Thank you in advance for everybody submitting them. Really appreciate it. It's always fun having these conversations. So let's jump in. From TS. Can you tie together the consequences of $2 trillion plus in federal deficits climbing to $3.5 to $5 trillion or more in a recession, the U.S. net international investment position, being negative 70% of GDP, and the nascent trend away from treasuries and the U.S. dollar as primary reserve asset? When you boil it all together, or when you put it all together and boil it down more accurately, either the Fed grows its balance sheet or the U.S. government crowds out global dollar markets at an accelerating rate. It sends the dollar up and everything else down, including Treasury bonds, sending the U.S. and everybody else, since the dollar is the global reserve currency, into a global death spiral of higher deficits, higher debt, higher rates, higher dollar, until the system collapses or until the Fed steps in. And the longer that goes on, the more incentive for global central banks to buy gold and not treasuries. You'll start to see gold outperform U.S. real rates and tips, which is exactly what we've seen since 2022. Ultimately because the U.S. government and any other governments can't afford rates above a certain level. And there's really nothing more positive for gold than sovereign debt crises. So that's when you put all those things together, you're going to get either a vicious cycle down debt spiral, or you're going to get an inflationary spiral up. It's no longer some dial where the Fed, if they just do the right thing, they can get into some nice little disinflationary period like they had for 20-25 years, from call it 95 through 2020. I don't think that's on the menu of options. From GC, do you see liquidity being really the only driver of asset prices going forward and the most important metric to look at? And do you see central bank liquidity expanding or contracting over the next 7 months? Maybe not the only driver of asset prices going forward, but I think if not the primary driver, and I think the most important swing factor. I see, and to answer the second part of the question, I see central bank liquidity expanding over the next 6 months, because if it doesn't, it implies a Western sovereign debt crisis getting much worse, perhaps starting as soon as a month from now here in the United States. Let's see. From JJ, does AI plus robotics equal that productivity miracle needed to prevent sovereign debt bubble dilemma? It's a bit of a paradox. In the long run, yes, I think it absolutely could be exactly that, a productivity miracle. However, between here and there, that productivity miracle is massively deflationary for wages, tax receipts, and as a result brings forward the fiscal problems of the West dramatically, and China as well, for that matter. So as unemployment surges, robots take jobs, etc., Western sovereign debt, global sovereign debt blows up, and then requires central bank backstops of that debt, which then ends up being inflationary, or UBI is brought to bear, something like that. So long run, yes. Short run, it accelerates what's setting up as a bumpy ride anyway. From QA, things are starting to take shape, but there are still long lags before market prices catch up to narratives and / reality. What metrics should we be looking for to know it's time to place bets so we don't get wrecked by volatility in the meantime? Tactically, I'm watching U.S. Treasury volatility very closely as just a kind of a signpost of where we are, a North Star of where we are at that moment in time in this process. Secularly, I'm watching true interest expense, Treasury spending plus entitlement pay-goes as a percent of tax receipts. Every time it gets near 100% or over, that is a huge moment. We're basically there now. That means either more liquidity comes or it doesn't, and things get really ugly really fast until it does come. I think it's really important in this process to remember where we are, which is we are in the first bursting global sovereign debt bubble in 100 years, at the end of a 50-year currency system where it's shifting from dollar reserve status, from dollar global reserve currency, Treasury primary reserve asset, to dollar global reserve currency, to I think in the meantime it's going to be gold going back to the neutral reserve asset. We're changing the system, though, is the point. And my point here is I think it's really important to remember it's going to be super hard to trade. I'm not trying to trade it. One of my best relationships on Wall Street is a veteran macro trader. You know, he says all the time, I don't think anyone's going to be able to trade this well. It's like I traded a long time for a living. It's going to be super hard to try to trade this. It's not something he's trying to do. I think it's important to remember gold price volatility in Weimar Germany. Remember, it was, even though they ultimately hyperinflated, and as always, I'm not saying we're going to hyperinflate. I'm just saying in a very extreme case that seemed like a one-way trade, it was anything but. You got carried out multiple times if you got too aggressive. So it's too political, it's too volatile, too much leverage. It makes the volatility, I think, is going to be a feature of our operating environment. We just need to adjust to it. So in my opinion, continue thinking better off being conservative with leverage, holding enough, plenty of cash, and then playing for what I think is the ultimate end game with part of the portfolio as well, and really thinking about this period in time in terms of surviving and stewarding your capital from one side to the other versus trying to win big through this process, because the volatility, the debt, the political volatility, there are real risks that trying to play for the swing for the fences, you end up striking out, for lack of a better word. From DC, can you expand, on U.S. plays trump card adopting Bitcoin as a reserve asset, given one, the U.S. currently has no Bitcoin reserves, and two, it's questionable that energy exporters accept Bitcoin as an asset, and three, choke point for Bitcoin. There was an interesting point on the potential choke point of Bitcoin in terms of the ability to choke it off in the internet. I'm just not technically proficient enough in terms of whether that is a possibility. My understanding is that is, in theory, one way you could stop Bitcoin is by shutting down the internet. However, the fault of that, the flaw in that strategy, you can see immediately, is that you shut down the internet, you're going to basically blow up the economy. Obviously, the paper in question that I read through, it wasn't about shutting down the entire internet. It's being able to sort of filter certain file types, and I just don't have enough technical proficiency to know the validity of that. So I'll put that out to some friends of mine, see what they have to say about it. In terms of the other two, the U.S. currently having no Bitcoin reserves, and whether energy exporters would adopt it. In my opinion, it's a little bit like what China's been using with gold. Is once you can get one big exporter to agree, then the announcement, basically that begins to force others to do the same. And the announcement, I think, itself would send Bitcoin to the moon, which would free up supplies probably domestically. It's not that the U.S., they have some, I think, that they've confiscated from the, whatever it was, the dark web use cases, is my understanding. But setting that aside, an announcement that U.S. trade would be settled in Bitcoin going forward as a possible solution laid out by Jason Lowery in his book Soft War, I think would send Bitcoin to the moon. It would ultimately amount to a massive dollar devaluation versus Bitcoin, which would then free up the Bitcoin held within our borders. At the right valuation of Bitcoin relative to U.S. debt, I would actually consider swapping out. That's a much higher price from here. But that is something to think about. If you got Bitcoin collateralizing the U.S. debt fully, as you saw with gold in 1980, that would free up supplies for use as a trade settlement mechanism. And I'm just thinking out loud here. And in terms of the relative advantage, you're seeing China and Russia use gold in this capacity. You've seen Bitcoin outperform gold since its inception. It is a harder currency objectively than gold is. that could actually seize back the advantage to, if we're moving to a neutral reserve asset. Russia and China combined produce more gold than the U.S. That would move it to a system that is capped and would then basically allow competition not based on who has the most gold reserves, but based on who's the most productive. And that's a situation where I think over time the U.S. does very, very well. So, JS, what happens if we reverse the 1913 Jekyll Island and give control of the U.S. currency to the Treasury, eliminate the federal income tax? Massive inflation, I think. I think that's a version of the Chicago plan, something called the Chicago plan, but don't hold me to that. I'm thinking out loud. But the gist of it is moving in that direction. I think we're moving in that direction already, marrying Treasury and Fed a bit more, or at least trying to force it in that direction. Right? When you're looking at things like reshoring industrial capacity, that's, I think, a direction that is possible, a la World War II. We're not all the way there yet, though. So that's what happens. If Treasury takes over from Fed, it's going to be inflationary. That's what happened in World War II. So that's the better way to answer that. So, and then JP, what's your opinion of Jeff Snyder's deflationary monetary or money scenario? You've said we might get deflation for about a cup of coffee. That I take you think it would be a very temporary event. It seems he dismisses a response to the deflation, or am I wrong? I love Jeff. I love Jeff's work. I think he's brilliant. I do think we could get a brief deflationary whoosh. I think that's fully possible. Where I disagree with him is that is the context of that deflation. In other words, U.S. debt levels are so high. U.S. deficits are so high, so structural. A sustained deflation would mean treasuries would quickly be at risk of default, as well as a lot of other global sovereign debt around the world without Fed QE. And so I don't think that would be a good scenario ultimately for treasuries, maybe initially, but again, the longer it went on and people began to realize, oh gosh, maybe they're not going to make the coupon payments if the Fed doesn't step in here, I think you'd see the market make a transition to gold as collateral, either by proclamation or rule or de facto. So that's where I disagree on how long it can be sustained. Any period of deflation can be sustained. And ultimately, the reason is governments with a fiat currency tend to not default on their debt. They can print the money. Yes, it requires gobs of printing. I think that's what they'll do if push comes to shove. And then finally from Tina, do you consider there's enough time left for another episode of Mr. X? I think maybe. I think we're getting towards the later innings here, but I think there could be a time still for another episode. I certainly have the material. I've written a number of reports for clients using Mr. X. So there's some material there. But let's watch. So with that, I'm going to finish up for tonight. I want to thank everybody for being here as usual. As always, if you like these updates, please check out FFTT Tree Rings, FFTT-LLC.com for more information about that. 10 most interesting things, brief synopsis on what grabbed this about each point. Usually it's something that either refutes a way we'd been thinking about the world before or adds further confirmation of a trend that is gaining momentum. We get a lot of great feedback on it. So thanks for joining me. As always, everybody have a great week. I look forward to chat with you soon. Take care, everyone.